I'm Alan Kenny, Editorial Director with REIT.com, and we're in San Francisco for REITWorld 2013. Joining me is Andy McCulloch, Managing Director with Green Street Advisors. Andy, the big story throughout the entire economy right now is interest rate policy. What do you see in terms of impact on private property market values?
I think it would surprise most people, but since the uptick in rates since late May, private market property values haven't moved that much. Cap rates have been pretty steady. We all know that cap rates and interest rates are correlated, so it's no surprise that real estate investors would get a little bit spooked when rates started to tick up. But I think why I think some of those concerns are overblown is that prior to rates rising, return expectations for real estate had really become decoupled from the appropriate fixed income benchmarks, mostly BAA corporates and high yield bonds. Said differently, the spread between return expectations for real estate and fixed income had become abnormally wide. What that means is private market real estate investors and real estate lenders had pushed cap rates down, but they stopped pushing cap rates down as interest rates continued to fall. And really what that created was a cushion or a shock absorber. And that kind of cushion absorbed this initial rise in rates that we've seen. And that's why cap rates haven't moved that much. It doesn't mean we haven't seen any movement in cap rates at all. We have seen multifamily cap rates tick up a little bit, but I think in multifamily you have some other things going on. It's the one major property sector where you've seen new supply start to come into the market. It's a sector that's seeing decelerating rent growth. You also have Fannie Freddie pulling back a little bit. And I think the single family market is getting better, and that spooks some investors, right or wrong. But outside of multifamily, in malls, strips, office, industrial, you really haven't seen asset values or cap rates move that much. And where you have seen any uptick in cap rates at all has really been in secondary and tertiary markets and in lower quality properties. Storage, actually, self-storage is an interesting one. Storage has actually seen falling cap rates in a rising interest rate environment, and that's pretty unique. I think Green Street has been a pretty big bull on self-storage for a long period of time, and we've been a big bull because we think the private market underappreciates self-storage's most attractive attribute, and that's low capex. Self-storage properties are pretty simple to operate, and they require a much lower level of ongoing capital reinvestment. And what that means is long-term after capex NOI growth is actually superior to a lot of other property types, and it seems like the private market is starting to wake up to that fact and pushing cap rates down.
So if interest rates keep climbing, what's going to happen?
Yeah, now that cushion that we talked about is gone, real estate looks roughly fairly valued today. So we don't forecast which way rates are going up or down, but I think if rates do continue to rise, now that cushion is gone, it's probably going to be bad for private market asset values. I think how bad depends on why rates are rising. If rates start to go up because the economy is getting better and you're getting some inflation, then landlords are able to push that inflation through via higher rent, so that those higher rents will offset higher cap rates to some extent. If rates are rising for a different reason, maybe a messy unwinding of QE, for instance, where real rates are rising, then the negative impacts to asset values can be more severe.
Anything in the listed REIT market that might be sending signals about the direction of the private market?
Yes, it's a good question. I think that the public market over time has been a pretty good predictor of future private market asset values. It's really why all real estate investors, whether they're investing in public securities or direct real estate, should really be paying attention to what the public market is telling us. But as of right now, the major food groups are trading pretty close to NAV today. And what that means is the public market is suggesting that private market asset values are going to kind of trade sideways for the next 6 to 12 months. So while it's volatile, the signal today isn't strong one way or the other.
Thank you so much for your time, Andy.
Thank you, Alan. Appreciate it.
And for more on this and other REIT news and analysis, be sure to check out REIT.com.